What is going on, investors? Hopefully you guys are doing well out there. That is right. It is time for the Investor Channel Bear Market Playbook. What are we looking to buy? What stocks? What sectors? What are we looking to do to capitalize on this massive decline in almost all equity and asset prices that we've seen since last year? First thing that we're going to do is make a shopping list. Now, I want to be clear. We're not making a shopping list on a Sunday and then going out on Monday and going and buying any of this stuff. We're just putting together a list of stocks and sectors that we want to get into, and then we continue to monitor the outlook and the data, which I'll get into more here in a second. But on my personal shopping list is obviously stocks, okay? A lot of them have come back big time. I'll give you some specific stocks that I am buying. Bonds, well, some of you guys are like, what am I, an old man? What am I, a grandpa? Am I crazy buying bonds? Absolutely not. In fact, out of all of these asset classes on this list, bonds might have the best risk reward setup out of all of these. And so bonds is very high on my list of an asset class that I am likely to get into very soon. We'll also talk about crypto, obviously FANG stocks as well. Anytime you're putting together a shopping list, you're going to do some major buying, you're going to do some allocation into some kind of investment account. Maybe you need to rebalance so you have some existing investments. What sectors are you a little light in? What sectors do you need a little bit more exposure in? What sectors do you maybe need a little less exposure? This is the time to analyze that. And then finally, for those of you that have been following the channel for any length of time, know that I have probably done one, maybe two videos in the lifetime of this channel on stocks under, say, $5 to $10. In a massive bull market, I don't think you need to really take risk on things like penny stocks. I think it reverses itself when you have a massive sell-off in stocks. It creates a lot of opportunities, which quite frankly weren't there before. Now, the first thing that I want to get out there is kind of our base case for the S&P 500, okay? This thing has declined more than about 20%. We are moving back up through the channel on the S&P 500. We'd fully expect this probably to get up to maybe as high as 4,000 on the S&P 500. Look, it could go as high as 41, maybe even 4,200. I personally think maybe over the next week or two, but we're still looking for a major pullback after that happens. In fact, I would probably be a seller of any rally up to the top of this zone on the S&P 500. Quite frankly, I'd probably be a seller only because we'd expect to come back and retest lower lows on the S&P 500, which are currently sitting right about that 3650 mark. That would put you well into correction zone 20%. In fact, if you get into this green box, which I've identified here, some sideways consolidation, that would be about a 30% peak to target on the S&P 500. Now, does that mean I think the S&P 500 is going to bottom out there? Does that mean that's where it's going to go? Absolutely not. We're just creating a little bit of a playbook. Remember, NFL teams create a playbook, and then on Sunday, when the game starts to unfold, maybe they have to make a little tweaks to that playbook. That's exactly what we're doing here today. Now, in terms of our outlook, I tell you what, if you have any ideas about the market, which way it's going to go, which way it might not go, that's essentially an outlook. And I typically look like 1 to 2 quarters out. I tell you what, if you ask me for my Q3 stock market outlook, which starts a week from Monday, it's identical at the current time to my Q4 outlook. But one thing about an outlook that I think needs to be said here on the channel is a lot of you newer and younger investors have grown up in kind of the hodl, laser eyes, diamond hands. Don't change your perspective. Just buy and hold and ignore all the noise. That's not what an outlook is, okay? An outlook can constantly change. And right now, this is how I think things are going to be setting up as we move into Q3. Now, first of all, what I think is already digested by the market. Notice I use the word digested and I don't use the word priced in, because with some of this stuff, I think we could survey the vast majority of people watching this video. The vast majority of investors out there probably realized that the CPI print coming up next month and the GDP print that we'll get is probably going to be an absolute disaster. There's very few economists and very few investors that thinks CPI and GDP is all of a sudden going to sing sunshines and roses in the month of July. It's just simply not going to happen. So I actually have that digested by the market now, leading into that print, leading into that number a day, a week before. The markets can position themselves one side side or the other, but for the most part, investors have already digested the fact that CPI is going to be terrible in July, probably August and September as well. The same thing with the GDP print. Now, we have earnings moving through the system in Q3 as well. I'll have above me some of the key earnings dates that we're looking for. Now, I think there's some bad earnings and some guidance misses that is already kind of priced into stocks. And notice I say some, it's not every stock, it's not every sector, but we saw FedEx report last week. And while it wasn't just this amazing report, well, the stock reacted really nice because the guidance was actually a little bit better. So as we move through earnings season, we might have to change our outlook based on the earnings guidance, how analyst estimates come in or stay the same. We'll change that as we move through earnings dates. Again, the dates are above me. Now, I think most investors are also digesting the fact that you have sticky inflation and sticky war, and that's not going to go away in Q3. All you have to do is drive by a gas station and you understand that inflation is sticking around, and obviously the news flow out of Russia and Ukraine hasn't gotten any better. Now, there is upside to our outlook. If any one or several of these events materialize in Q3, it would get us to materially change our outlook, not only probably for Q3, but probably Q4 and beyond. The first thing is if you get some kind of Russia or Ukraine peace deal, ceasefire, and also understand how this conflict is being fought, so to speak. Okay, you have the boots on the ground. There's an actual physical fist-to-fist war going on, but the way the West is fighting this war is economic sanctions, not allowing Russia to have exports and have money flow into the country. They're playing it that way. That could be pulled off the table at some point. The conflict itself could continue to go on, but if all of a sudden the West, like the United States and Europe, says, well, okay, Russia, our approval ratings are so bad because gas is so high, we'll take some of your oil to lower the price. We'll take your potash fertilizer and all these types of things. If that gets pulled off the table, but the conflict still goes on, well, that still is upside, quite frankly. Better CPI data. If somehow the CPI data looks better or people interpret it better, well, that obviously could upside the markets. You got lower oil prices. That essentially ties into CPI data. If you drive by your gas station and it's 30, 40, 50, 60 cents lower than the week or month before during Q3, well, obviously that will improve our outlook as well. And also you have earnings and guidance. Again, earnings season coming up in the next couple of weeks. We're looking to see how the subsequent quarter went, but also the future as well. See how these executives talk about the upcoming quarter. Now, just like we have upside with our outlook, there's downside as well. Oil out here in California goes to $8, $9, $10 a gallon. Forget it. Stock market's probably going to continue to sell off. If the panic in the crypto market, in the stock market, if that transfers over to real estate, then all of a sudden we see panic selling and panic in the real estate market. I don't think that's priced into the market or even digested by the market. That could be a major factor to the downside. Also, job market panic. Right now, it seems to me if you wanted a job, you probably could find one and start working pretty quickly. If that goes away, that would also cause people to panic. Also, you have disastrous earnings as we move into earnings season. If they're so bad and the guidance is so bad, especially from key companies like Apple, Microsoft, Amazon, Google, Facebook, Netflix, if these companies absolutely lay a brick, well, of course, everything is going to pull down. So that's our Q3 outlook. And obviously week to week, even in some cases day to day, this thing can change a little bit. And I've tried to outline it here, what I'm looking for. Now, in terms of our shopping list, we are absolutely looking to get back into stocks. And in the environment that we are in, I am looking for a tight group of stocks that have profits, that have cash flows, and that probably have dividends, and that maybe have buybacks as well. If we're in for a stagflation, a sticky inflation, a long-term kind of higher interest rates heading well into the future, we're looking months, maybe even years down the road, well, the companies that I want to invest in have profits, have cash flows, do buybacks, and pay dividends. And obviously on that list, there should be no surprise to most of you that tune into this channel. That would be Apple, Microsoft, Google in particular. Then you have Amazon and Nike. You have the financial financials as well. I think you can capture most of that with Bank of America and JP Morgan. You also have Visa you could throw in there as well. Again, buyback, growing dividends, profits, cash flow. All these companies have this in common to a certain degree. And then what I like to do is throw a little bit of beta or a little bit of high growth into my portfolio. And the two companies that I like to do that with, again, flowing with the same vein, I'm looking for companies with profits, cash flows, doing buybacks and dividends. If you have high growth, I could do without the buyback, I could do without the dividend. And in some cases, that applies to Tesla and Nvidia. Both of those companies have high profits. They both have high cash flows as well. That makes it a great addition to a portfolio, quite frankly, made up of a lot of kind of low to mid-teens, even single-digit revenue and profit growers. Well, you got to have a little beta in there, and I get that through Tesla and Nvidia. Now, here's probably one of the best opportunities, I would say, probably over the next 2 to 3 years in the stock market. It's actually in bonds. Now, a little bit of economics 101 is when rates go up, and you know what the Feds are doing, the Federal Reserve just continues to inch up interest rates. Now, the bond market is already kind of out in front of that, and we've seen rates tick up on bonds. When rates go higher on bonds, what happens to the price of the bond? It goes down, okay? And then when rates go down, what happens to the price of bonds? They go up. It's an inverse relationship. So there's we're talking about huge upside. If you're sitting there watching this video and you don't think CPI will get any better, not just the next quarter, but the next couple of quarters, inflation is just going to continue to run rampant. And the Federal Reserve, the only tool they have in their tool chest is continuing to raise rates. What's that going to do to the price of bonds? It's going to send it lower. What are you trying to do as an investor? You're trying to buy low. So as those prices continue to go lower, it creates more and more buying opportunities. So if you think the Fed is going to keep raising interest rates, bonds is probably your best opportunities. Now, generically, I have some bond funds down here. It's really easy to do some research on some bond funds. Just find the most liquid ones. That would be my opinion. Now, here's the TLT, which is essentially a 20-year treasury. Guys, 2 years ago, this was up over $171 per share. Now it's down over 34%, down to about $112. It shows you, I know the bonds get this rap of it's only for grandpas and it's safe. No, you have tremendous price swings on bonds. You had a 30% move in bonds just over the last 18 months. That's unbelievable. You even have a drop from 150 back in December. We're talking about just over the last 6 months. You've gone from 150 on TLT all the way down to 112. Guys, that's your upside when and if CPI inflation starts to clear up. Everybody's like, okay, Fed, you got to take your foot off the gas and actually start lowering interest rates. What's going to happen to TLT when the Fed has to pivot, guys? This thing is going to shoot up, okay? Anything above 4, anything above 140 on the TLT is essentially kind of a zero or a really low interest rate policy. Down here in the 112s, obviously it's like a 2 or 3% interest rate policy. So you've got some ways to move. You got a lot of upside in bonds. I wouldn't buy them tomorrow. I wouldn't necessarily buy them next week. You're really keeping an eye on inflation. Again, understand that the bond market is going to move before the Fed is going to move before the data is crystal clear. You don't have to catch this on the bottom. You just want to catch the momentum. Once bonds change momentum, I think you've got a great opportunity there and not a ton of risk. Now, speaking of risk, holy crap, you have a ton of risk in crypto, but when something like this pulls back so much, there is great opportunity. Now, I'd say the one thing that's risky about crypto, the more it continues to pull back, we're seeing these bankruptcies and these kind of insolvency events that might spark some regulation. And so that would change the investment thesis in crypto if all of a sudden the United States government or Europe or one of these larger governments decides to really regulate crypto. So that's something to just keep in mind. But personally, I will stick to Bitcoin and Ethereum. If you want to get out there and look at all the different coins and trade them and do all that, that's fine. My target on Bitcoin is down here at about 13.5. That's not my rock bottom price, but that's where I'd really start to get interested in it. That's as we pull back those essentially kind of like 2017, 2018 highs. The reason why I picked that out is you've got a longer term uptrend. I think those two could converge right in that 10 to 15,000 price range over at Bitcoin. Same thing with Ethereum. Look at this topping pattern on Ethereum. Holy crap, this thing's rolled over. It's retesting kind of the 17, 18 highs again, just like I think Bitcoin will do. It'll retest these highs. I think Ethereum slices through this and then pulls back into kind of a green box that's south of about 500 on Ethereum, currently sitting at about 1,200. I certainly think you've got a lot more downside left in crypto, but you got some great buying opportunities, and this is something that I would buy low, and then as you get these rips higher, I would personally take profits. I don't view crypto as a buy and hold just based on the regulatory and the volatility in this. I'd rather play the volatility, the kind of ups and downs in crypto. Now, the other thing that you need to think about in your playbook is, do you need to rebalance over the last year, 2 years, 10 years, 20 years that you've been investing in stocks? Have you gone overweight certain stocks, certain sectors, and kind of ignored others? That's certainly possible. So me personally sitting here today, I need to add a little bit of healthcare exposure. I am underweight real estate. I probably definitely won't get into that market anytime soon until we get maybe some clarity on rates. I'm also underweight materials as well. Any type of economic comeback, which I'm certainly not projecting anytime soon, but I'm projecting a recession and then a comeback. Materials, real estate, healthcare tend to do relatively well in those types of times. Now, what sectors are out of favor? This is what you also want to focus on. And I would say this is shorter term money. This is where you can kind of play the bounce, play the rebound, play the comeback. That would be ARK Innovation Fund, not necessarily the ticker ARKK, but the stocks that are associated with that. I'll show you more detail that on a second. Obviously, crypto, which we just talked about. You have discretionary, all types of luxury goods, all these types of things definitely can be included. And obviously bonds. I talked about earlier, bonds is a great opportunity, and that sector is completely out of favor. Reminds me a little bit of oil a year or two ago, and then we've obviously seen the rise of crude oil. Some of these sectors that are out of favor right now, in a year or two, everybody will be talking about them and everybody will be trying to allocate their money onto them. And by then it's too late. By then you really should be taking profits. Now, when I talked about ARKK, I would not buy the ARKK fund. And look, if you want to, if that's something you want to do, that's fine. I have expertise in a lot of these stocks. I've done a lot of due diligence on them. I would cherry pick probably the 3 or 4 that I think that actually are worth investing in. Number 1 is Tesla, Coinbase as well, Roku, and Shopify. I don't know if Shopify was an ARK stock, but it's one of these high flying stocks that has come back so much, that has a real business, that has real cash flows, they don't really have a lot of profits yet, but they're getting there over at Shopify. These stocks I certainly would be interested in. If I had to buy one today, it obviously would be Tesla. It's one that I already own, but these other stocks, the more they get beaten down, certainly can create some buying opportunities. Now, finally, would I recommend buying any penny stocks as we have a market correction? And I will say right off the bat, probably, but I don't think a lot of people watching this understand the research that goes involved in buying a good penny stock. I'll give you a very specific example on a penny stock that I bought back in 2016. In fact, I wrote an article on Seeking Alpha. This is me right here. This is my name. On May 6th, 2016, when the Joint, which is a kind of a franchise chiropractic stock, ticker symbol JYNT, this stock was at $3.20. I published an article being very frank that it's time to own this stock. And this was a healthy amount of research. I called franchise owners. I talked to employees. I talked to a lot of people. I think people think they can just turn on YouTube, see the ticker JYNT and buy it and all of a sudden become rich. That's not how it happens. I did an extensive amount of research on this stock. I said it's time to buy. It was $3. Now, currently, if you had held this stock, which I think would be a tremendous mistake, it's currently a $15 stock. That would still be up over 370% since I suggested selling, but I actually sold late last year. I didn't quite get it at the highs. The highs are at $111 per share. I think I sold it in the $80 and $90 per share. And some of you might be wondering, what did I do when I bought the stock for under $3 and I sold it for $80? What did I buy? Well, it's on my wrist. So there's what I do with my penny stocks, folks. I do a ton of research. I mean, I did hours. And in fact, those research days, I wrote an article about the Joint in 2014. I did hours and hours and hours of research in this company over the course of several years, made my move, sold it when it was kind of apparent that stocks like this were about to fall out of favor, and I put something on my wrist. That's what I would suggest you do with crypto, you do with any of the ARK Innovation allocation funds and the speculative stocks out there, we are holding our profitable companies, our cash flow companies, our companies that are doing buybacks and dividends. This is what you surround your retirement around, your bedrock, your foundation of your investment and your portfolio. In times like these, when things start to pull back, I think you can dabble with a little bit of speculative stuff. I think you can look at crypto, and then certainly you can look at penny stocks and stocks that have gone down quite a bit. Just understand when you get into these penny stocks, this speculative stuff, you've got to pick an area where you're willing to take profits, or at the very least get stopped out of as the momentum comes out of the name. The momentum, or out of all the speculative stocks, the momentum will come back. That's where a great buying opportunity comes. Hopefully you guys enjoy today's bear market playbook. Certainly just chapter 1 of this playbook. We'll have many, many more, as this recession will likely linger on into the future. I'll be here to cover it for you. Leave me a comment or question down below. I'll be happy to answer to them. Hopefully you guys have a great day out there. Good luck with your investments.